Welcome, curious minds, to the Deep Dive, your ultimate shortcut to really understanding what's happening beneath the headlines. Today, we're cracking open Univest Financial Corporation's second quarter 2025 earnings call. That was back on July 24th. Our mission, like always, is to sift through the numbers, the commentary, and boil it all down to what really matters for you. And this Q2 report for Univest, it's got this fascinating dual narrative, doesn't it?
It really does.
You've got impressive core financial strength on one side, but then it's kind of up against this surprisingly sharp, though maybe isolated, credit challenge. So we're going to unpack this tension and figure out what it truly means for the bank and the wider regional sector.
Exactly. We'll be dissecting Univest's latest financial performance, taking a hard look at management's strategy talk, and crucially, connecting all those dots, helping you understand the implications for the whole regional banking scene. So get ready to not just hear the numbers, but understand the nuances.
Yeah.
Pinpoint the pivotal takeaways from this release. It's quite a story. Resilience mixed with, a bit of the unexpected.
Okay, so let's kick things off with a quick look at the headline figures, the first glance stuff. Univest Financial reported net income of $20 million for Q2 2025.
Right.
Now, for those tracking earnings per share, that translates to 0.69 cents per diluted share, which is actually an encouraging 11% increase year over year, up from their 62 cents same time last year.
Yeah, decent bump there.
Revenue came in around $81.04 million. That's showing a, modest 5.7% increase year over year. Not exactly blockbuster, but, solid.
Solid, yeah. But where things really shone this quarter was net interest income, NII.
Ah, right.
That figure jumped to a pretty robust $59.5 million. That's up an impressive 16.7% year over year.
16.7%. Wow.
Yeah. And crucially, their net interest margin, the NIM, the difference between loan earnings and deposit costs, usually tax equivalent for comparison, that expanded nicely, came in at 3.20%.
Okay, 3.20. That sounds good in this environment.
It is. But it wasn't all smooth sailing, was it?
No, definitely not.
The quarter also saw a pretty big jump in the provision for credit losses. That hit $5.7 million. And net charge-offs, basically loans they've given up on collecting, they surged to $7.8 million.
Oof.
And this big increase was mainly down to one specific commercial loan. We'll definitely need to dig into that one later.
Yeah, absolutely. So the market's reaction, it seemed kind of muted, didn't you think?
It did, yeah. Relatively subdued.
It sort of indicated this cautious but maybe not overly worried stance from investors. Like they were saying, okay, we see the good, we see the bad, let's wait and see.
Exactly.
Which is pretty interesting, especially with those positive underlying trends you just mentioned. It shows the market's really paying attention to the details right now.
Absolutely. That muted reaction, it really highlights the market's sensitivity to credit quality these days, even when you've got strong operational stuff happening underneath. But let's delve deeper, starting with that impressive net interest margin expansion, because that really does make Univest stand out in what's, frankly, a tough environment.
Right.
So the reported 3.20%, that's a notable increase, not just from the 2.84% in Q2 last year, but even up from 3.09% just last quarter, Q1 25.
Okay.
And this expansion, it was driven by, increased yields on their assets, sure, but also, remarkably, a reduction in their cost of funds.
Wait, a reduction? How do they manage that now?
Yeah, that's the really insightful part, isn't it? It's not just the NIM expansion, but how they did it. Reducing cost of funds when rates are generally up and banks are fighting for deposits.
Right. Everyone's costs are climbing.
Exactly. It signals maybe some exceptional treasury management, or maybe they just have a really sticky, lower cost deposit base.
Yeah.
Either way, it gives them a serious edge over a lot of their regional peers. It's more than just good performance. It's a strategic differentiator.
Okay, but here's where it gets interesting, right? Looking ahead to Q3, management does expect their core NIM, which, takes out the effect of excess liquidity, gives a cleaner operational picture. They expect that to contract slightly, just a few basis points.
Right, a slight dip.
And they're putting that down to the repricing of their 2020 subordinated debt, basically old debt resetting at a higher rate, and also a seasonal increase in higher cost public funds.
Okay, makes sense. Seasonal flows.
Yeah. But despite that slight dip in margin, they still think net interest income will stay relatively flat compared to Q2.
So margin down a tick, but overall interest income holding steady. That suggests their asset growth is helping offset it.
Seems like it. Now, moving beyond interest income, what about non-interest income?
Also pretty healthy, actually. Showed a 2.5% increase year over year, reaching $21.5 million.
Okay. What drove that?
Mostly increases in investment management fees, also gains on selling SBA loans, those small business loans, often government-backed, good to sell on, and treasury management fees.
Gotcha. Diversification helps.
Absolutely. These diverse streams are crucial, right? They offer resilience when the core lending business faces headwinds. Now, this growth did partially offset a decrease in net gains from mortgage banking, which, well, no surprise there, right?
Yeah.
The higher rates have definitely hit that business.
Yeah, tough environment for mortgages. Okay, now, let's address the elephant in the room. Or maybe the very specific elephant. Credit quality.
Right, that big jump.
The big increase in net charge-offs to $7.8 million. As you said, largely down to one specific commercial loan, $23.7 million.
A big one.
This loan got put on non-accrual, meaning they stopped booking interest income because, well, they probably won't collect it due to suspected fraud. And $7.3 million was already recognized as a charge-off.
Yeah.
The silver lining, maybe, is the remaining $16.4 million is backed by appraised real estate collateral.
Hopefully solid collateral.
Let's hope. Management really emphasized that without this specific relationship, the overall credit quality of the portfolio is still strong.
They were very clear on that.
But they also said no further comment because of an active investigation. So while they say it's isolated, what's your take? Does this raise red flags about their, due diligence? Or is it truly a one-off?
That is the critical question, isn't it?
Yeah.
I mean, on the surface, a $23.7 million loan going bad because of suspected fraud, it definitely makes you scrutinize their underwriting, their internal controls.
For sure.
It shows even strong banks aren't immune. But, management acted quickly, placed it on non-accrual. They were upfront about the investigation. And there is that collateral backing a big chunk of what's left. So it does suggest maybe a contained issue rather than some systemic weakness. The real insight for investors, I think, is what it says about their risk management vigilance. I mean, the capital loss is manageable for a bank Univest's size, but the reputational hit, questions about operational integrity, that could be worse if not handled carefully.
Right.
The market reaction being muted suggests they're getting the benefit of the doubt for now, assuming it really is isolated.
Yeah, that makes sense. It's definitely a reminder that surprises can pop up, making that due diligence crucial. Which brings us to another key area, loan growth. Or maybe lack thereof.
Yeah, that was a bit counterintuitive.
Because they had robust commercial loan production year to date, $507 million compared to $402 million last year. That sounds great.
That's fantastic.
But then loan outstanding is actually contracted, down $31.9 million in the quarter and $25.4 million year to date. It's a bit of a head scratcher.
It is.
Management's explanation was it's mostly due to early payoffs and paydowns, not a lack of demand, not increased competition, just existing customers paying off loans faster.
Yeah, that's what they said.
So what does that tell us about the economy, maybe? And what are they expecting going forward?
Well, it's a dynamic you often see when interest rates fluctuate, right? Businesses or individuals who took out loans when rates were maybe higher, they might jump at the chance to refinance or pay down debt if conditions shift or if they've had good cash flow.
Okay.
It creates this churn. Strong new loan production gets offset by these accelerated payoffs. Management expects this payoff activity to slow down in the second half, which should then lead to net loan growth.
Right.
The key positive signal, though, is that demand for new loans is strong, and their production is up year over year. That says good things about their market position and their customer base. They're finding borrowers. It's just the existing book turning over faster than expected.
Got it. And what about the other side? Deposits. Saw some movement there, too, down $75.8 million overall.
Yeah, but there's a nuance there.
Right. Mostly seasonal decline in public funds, reduction in broker deposits. If you exclude those, deposits actually increased by $77.5 million.
Exactly. That underlying core growth is key.
Management noted the competitive environment, which, yeah, no kidding, but they reiterated their focus on specific campaigns, niches to keep growing deposits. Sounds like they're being pretty strategic.
Absolutely. I mean, the competition for deposits is fierce. Money markets, high-yield savings, they're pulling funds.
For sure.
For Univest to show organic growth, excluding those volatile public and brokered funds, that really speaks well of their relationship banking model, their ability to offer value in their target markets.
So their core base is sticky.
Seems like it.
Yeah.
Sticky and expanding, which is vital for keeping funding costs stable. And that proactive approach, it definitely ties back to that strong NINAM performance we talked about earlier.
Right, it all connects. Okay, so what's truly fascinating here is their guidance. Full year 2025. What are they projecting?
Okay, so they expect loan growth of about 1% to 3%.
Modest, but positive.
Yeah. Net interest income growth, though, 10% to 12% compared to 2024.
Wow, that's strong, even with the 2-3 margin pressure.
Apparently so. Provision for credit losses guidance, that remains unchanged, to $12 to $14 million. And they reiterated it's event-driven, meaning, it depends on things like that fraud case.
So they're not expecting more systemic issues based on that guidance?
Doesn't seem like it. Non-interest income, projected growth of 1% to 3% off the 2024 base. Non-interest expense, expected to grow 2% to 4%.
Great managing expense.
And tax guidance, unchanged at 20% to 20.5%. So you add all that up, the aggregate impact. They expect it to be accretive, meaning it should boost both EPS and their pre-provision net revenue. That's like their core operating profit before loan loss provisions.
That's a lot of numbers, but the overall message seems like cautious optimism. Would you agree?
Definitely. The guidance paints a picture of sort of controlled growth and operational efficiency. That 10% to 12% II growth for the year, this is particularly strong, right? Suggests confidence in their asset generation and funding plan. And keeping the provision guidance steady despite the Q2 charge-off that really underlines management's view that the fraud case is isolated.
Right. They're sticking to that narrative.
Yeah. And the projected accretion to EPS and PPNR suggests they expect top-line growth and operational leverage to actually improve profitability, even with rising expenses. It's not just optimism, it feels like a specific roadmap.
Okay. Finally, let's touch on capital deployment. They've got healthy capital levels. What's the plan?
They plan to stay active with share repurchases. They view them as an effective use of capital, even with the stock price having risen a bit.
That's a good sign, isn't it? Management buying back shares usually signals confidence in the company's value.
It absolutely is. Shows they think the stock's undervalued relative to its intrinsic worth. Plus, it can boost EPS by reducing the share count.
And M&A. Any deals on the horizon?
Not an immediate priority for whole bank deals, they said. But they are open to non-bank opportunities. Things like insurance or wealth management acquisitions.
Diversifying revenue streams. Smart move in this landscape.
Very much so. Given the challenges in consolidation in traditional banking, acquiring businesses in less capital-intensive fee-based areas, it makes sense. Diversifies earnings, potentially reduces sensitivity to rate swings and credit cycles, builds a more resilient platform overall. We're seeing more regionals look at that.
Okay, so we've laid out the numbers, the nuances, the risks. For our listeners who might be a bit more, let's say, adventurous, what might a deep dive into a potential trade look like if we were, brainstorming like a hedge fund committee?
Okay, a fun challenge. Well, Univest Q2, it really highlights that dual narrative, right? Strong core operations, NIM expansion, diverse non-interest income balanced by that emerging, though hopefully isolated, credit issue, fraud-related loan. The market's quiet reaction suggests that wait-and-see approach, acknowledging the good stuff, but keeping an eye on that credit risk.
Yeah, and the whole regional banking sector, it's still facing margin pressure, credit risk. So Univest bucking that trend on margin is positive, but it's definitely tempered by that credit event. So key things to watch going forward. Q3 margin, how that debt repricing and public funds impacted.
Definitely.
And obviously any updates on that non-accrual loan, the resolution, the collateral situation, that's critical.
It's absolutely critical.
Investors also need to watch that dynamic between strong new loan production and the paydown shrinking the overall book. And deposit stability, can they maintain that in this competitive environment?
Plus the broader macro stuff, right? Fed policy, overall health of regional banks. That all influences sentiment.
It really puts Univest at kind of an inflection point, doesn't it? Their credibility really hinges on handling this credit stress effectively while keeping the balance sheet stable and investors confident.
Well said. Okay, so considering that situation, the credit hiccup, but management's confidence in the collateral and the otherwise strong performance, here's an idea for the adventurous listener.
Okay, lay it on us. A short-term bull put spread on UVSP. Are you trying to give people heart palpitations, or is there some method to the madness? Explain that for someone looking for a maybe cautiously optimistic play.
Hey, no palpitations intended. It's really a calculated bet on stability, not some wild gamble. Okay, so the stock's around $30.14. You could simultaneously sell an out-of-the-money put option, say strike price, below the current range, maybe $27.50.
Okay, below current price.
And at the same time, you buy a further out-of-the-money put, lower strike, maybe $25, same expiration day, maybe 60, 90 days out. This setup, the bull put spread, basically lets you profit if the stock price stays steady or drifts up slightly, and your risk is defined, limited.
Okay, so if I'm following, you're betting the stock has probably already priced in the bad news about the charge-off.
Essentially, yes.
And that the underlying operational strength, especially that in, will act as a floor, preventing a big drop.
That's the thesis.
Selling the $27.50 put brings in premium income, and buying the $25 put caps your potential loss if the stock does somehow tank unexpectedly. So it's a bet that the credit issue really is contained.
Precisely. The strategy aims to profit from stability or a modest rise. Seems plausible given the market reaction and the company's underlying strength outside that one loan. Max profit is limited. Yeah, that's typical for spreads. But the risk is clearly defined too. Gives you a cushion against minor dips. It's a way to play for stability or recovery without the full risk of just buying the stock outright. A calculated wager on management navigating these concerns.
Okay. So to recap then, Univest Financial, a mixed Q2, showcased, robust net interest margin expansion, diversified non-interest income streams. Good stuff. But also grappling with that significant, though seemingly isolated, credit charge-off.
The big caveat.
Management seems disciplined with capital continuing share buybacks, and they sound optimistic about loan growth picking up in the second half, even with this credit issue.
Yeah, and while the market's response was kind of muted, the core fundamentals look pretty solid. If they can navigate this credit scrutiny without any more nasty surprises, it really sets the stage, doesn't it? Yeah. How well can they absorb and resolve this specific stress while keeping everything else stable? Investor confidence is key now.
Absolutely. The critical takeaway here really is watching how that isolated incident plays out. Its resolution, or lack thereof, could really define Univest's story for the rest of the year.
Couldn't agree more.
Okay, and remember everyone, all this information is strictly for educational purposes. It is absolutely not financial advice. Always, always do your own due diligence before making any investment decisions.
Please do.
That is all for this deep dive into Univest Financial from TalkTickers. We really appreciate you tuning in. We look forward to hearing your thoughts and your questions. Until next time, keep digging for those insights.